When you hear money creation, you probably imagine printing presses running day and night. But here's the truth. Most money isn't printed, it's created digitally. And the process is far stranger than you think. This is the central bank model, and today we're breaking it down in simple terms. Less than 10% of the world's money exists as physical cash. The rest, it's just numbers in bank accounts. So, who actually makes this digital money? The answer is central banks and commercial banks together, and they do it through a system that shapes our everyday lives. Think of the central bank, like the Federal Reserve in the US, as the referee of the economy. It doesn't just hand out cash, it sets the rules of the game. This is called monetary policy. Here's how it works. Interest rates. The Fed sets the base interest rate. Lower rates make borrowing cheaper, encouraging people and businesses to take more loans. Higher rates make borrowing harder, slowing the economy down. Money supply. Central banks can create digital reserves, basically electronic money that sits in commercial banks' accounts at the central bank. Buying bonds. To pump money into the economy, the Fed buys government bonds from banks, paying them with newly created reserves. This gives banks more money to lend. Now, here's the surprising part. Commercial banks actually create most of the money we use. When you deposit $1,000 in your bank, the bank doesn't just keep it in a vault, it keeps a small fraction, maybe 10%, as reserves and lends out the rest. When that money is lent out, it gets deposited into another account and then lent again. This process is called fractional reserve banking. So your $1,000 can eventually become $9,000 or more circulating in the economy. In other words, loans create money. When a bank approves a mortgage or a car loan, it's not handing you cash from someone else's savings. It's typing new money into existence. This system means the supply of money grows as people borrow. That's why debt is at the heart of modern economies. If people borrow more, money expands. If borrowing slows, the money supply contracts. It's like the economy is addicted to credit. Without new loans, the system struggles. But this model isn't risk-free. In 2008, banks lent recklessly, creating too much bad money in the form of risky mortgages. When borrowers couldn't pay back, the system collapsed. Central banks had to step in, creating trillions in new reserves to rescue the financial system. This emergency measure is known as quantitative easing. It kept banks alive, but it also fueled future inflation and inequality. Today, central banks are exploring a new idea, central bank digital currencies, or CBDCs. Instead of only working through commercial banks, they could issue money directly to people's digital wallets. This would give central banks more control, but also raise big questions about privacy, freedom, and the future of money. So, how is money really created? Not by printing presses, but by policies set at the central bank and loans issued by commercial banks. Every dollar in your account is the result of debt, trust, and a system designed to keep the economy moving. And the next time you swipe your card, take a loan, or hear about interest rates, remember, you're not just spending money, you're participating in one of the most powerful systems on earth, the central bank model. If you want more clear breakdowns of how money and banking really work, hit like, subscribe, and share, because once you understand how money is created, you'll never look at it the same way again.